Imagine this. On your screen, you are staring. Silver is now showing a $91 official spot price. You attempt to purchase 1 ounce of physical metal, but it appears to be a new record. Place a call to your dealer. All of a sudden, the number changes when you check the online inventory. The amount shown on the invoice is $91. Here it is, $104, missing $13. I don't see a spread there. A structural failure has occurred. The channel is glad to see you back. This is a message for the bystanders, for those who prefer real results than empty rhetoric. Something crucial has broken in the financial system's plumbing, and the mainstream media is praising new stock market highs while this is happening. Sales have been halted by the United States Mint. Give it to me again. Coinage has been temporarily halted by the government agency in charge of it. This isn't an error. The official separation between paper price and physical reality has been publicly acknowledged. Right now, I really need you to help me out. Please exit all other tabs, disconnect the TV, silent mode is required, because what I'm going to demonstrate is not a forecast. I want your undivided attention. This is happening right now, and it's a mathematical certainty. I need to know who's here before we can analyze the data. Please inform me from where you are observing this collapse in the comment section. Would you happen to be in New York during this time? Will you be in London? Also, are you keeping an eye on the premiums from Singapore as they go up? Just write it down. We need to descend into the engine room to comprehend why the metal price is decoupling from reality. The futures market's inner workings need our attention. In most cases, this is dull. In most cases, it's merely spreadsheet data. However, the engine room is currently engulfed in flames. The exchange's weapon for controlling prices deserves our attention. The margin requirement is what it's called. In simple terms, this is how it works. You don't have to pay the whole price for a silver contract on the main exchanges. A deposit was made by you. Margin refers to that initial investment. Speculators can own large quantities of silver with minimal funds because to this. We call this leverage. It drives the paper industry. The silver exchange has a long history of intervening when the price of silver becomes unsustainable, threatening the financial stability of large institutions that are shorting the metal. The necessity for margin is increased. They inform the traders that they must increase their capital in order to maintain their position open. Here we have a speed bump. Intentionally, it will make the leverage players sell. The weaker players fold as the margin increases. The price plummets as they unload their contracts. It is always effective. It was effective in 2011. Well, that was in 2020. This kill switch is ideal. However, when they pressed the brake lever this week, they were unsuccessful. The margins were raised in the exchange. The cost of maintaining a long position was increased. As far as the rules of financial gravity are concerned, the price ought to have fallen. Instead, it was unsuccessful. The silver price ignored the news and continued to rise. In forensics, this is an important detail. It reveals some disturbing information on the current buyers. If the advance was not halted by the margin hike, it indicates that the buyers are not inexperienced speculators utilizing borrowed funds. They are not in it for the short term. These are entities that have a lot of money. These purchasers are making cash payments. Since they aren't using leverage in their trades, they aren't worried about the margin call. Their anticipation of delivery is palpable. Here we get at the leverage ratio, the single most risky statistic in the world of international finance. Take a peek at the debt clock right now and see what the silver paper to physical ratio is. Presently, it is trading at around 356 to 1. Give that some thought. In the market, you can find 356 paper claims for every ounce of physical silver stored in registered vaults. An ounce of silver is considered to be owned by 356 individuals. Since heavy metal isn't exactly in demand, this musical chairs scenario might work just fine in a typical market. All they care about is making money. As the music continues to play, they exchange papers. However, everything comes to a halt when the spread between the actual price and the market price reaches $13. With a physical bar worth $104 and a paper contract for $91, why keep on to the paper contract? I don't think so. Upon delivery, you would stand. I would expect you to insist on having the metal. The calculations stop working at that point. The vault will immediately go to zero if even a small percentage of those 356 individuals want the physical metal. A short squeeze describes this situation. Contrary to meme stocks, this is not a quick squeeze. The bank is being attacked. This is a catch-22 for the bullion banks that peddled these worthless assurances. Their market bet is going against them, and they're trying to short it. With each additional dollar, their liquidity is dwindling by the billions. To artificially lower prices, they would typically print additional paper contracts and flood the market. However, meeting a delivery need cannot be accomplished by printing actual bars. A phenomenon known as backwardation is taking place. You should be familiar with this technical word. Due to the need to cover storage and insurance costs, the futures price of a commodity is typically greater than its spot price. The spot price, however, is currently showing indications of trying to surpass the futures price. Thus, metal is currently commanding a premium price in the market. Definitely not next month, going to miss it next year, right now. When a supply chain breaks, you hear this. Originally intended to dampen volatility, the paper market is now a major source of it. When the official price is lower than the street price, it means that the system is attempting to conceal the truth that the vault is empty, or that the emperor is without clothing. We are witnessing the demise of the paper pricing system when the US Mint suspends sales and margin hikes are unable to halt the surge. Sorry, but the control tools don't work. In their hands, the wheel has come off the steering. On the flip side, a separate game is being played across the globe as the West tries to control the exit using paper games. Real metal, enormous inventories, and a total lack of care for the New York price setter are all components of this game. Looking at the specters of the past can help us grasp where we're going. The financial media quickly recycles the same old narrative whenever silver begins to move vertically like this. Specifically, the Hunt brothers are brought up. They bring up the year 1980. Allow me to acquaint you with the case file for those of you who are unfamiliar. In 1979 and 1980, two Texas oil magnates named Herbert and Nelson Hunt sought to dominate the international silver market. They purchased actual metal. A futures contract was purchased by them. The result was a price increase of almost 50%, from $6 to almost $50. They sent shockwaves through the business. Excessive brutality was the response of both the government and the exchanges. Midway through the game, they decided to tweak the rules. Orders limiting actions to liquidation were imposed. They increased margins to levels that could not be satisfied by mathematics. The Hunt brothers were vanquished, and the price of silver plummeted to a low point that would last for decades. You may have heard from the news that this is occurring once more. They claim that the regulators will soon burst this bubble created by speculators. Their words are deceiving you. The organizations purchasing silver today are not two Texas cowboys, and the year is not 1980. The world's financial system is experiencing a dramatic change in its focal point. In 1980, the US and UK were the only two countries with any real influence. They had command of the safes. They had sway over the price system. The rules were regulated by them. That authority has broken down today. Behold the metal pores. A huge arbitrage opportunity between the West and the East has been opening up over the past 2 years. Shanghai and Mumbai silver spot prices have been steadily outpacing their New York and London counterparts. A rounding error did not occur here. Premiums of 10%, occasionally 15%, are being discussed in the realm of high finance. Algorithms can typically close a 1% arbitrage gap in a matter of seconds. Discontinuity of 10% over several months does not constitute arbitrage. This is a Hoover cleaner. This is a sign that the West is being drained by the East. The process is straightforward. What would you do if a bar of silver could be purchased in London for $91 and sold in Shanghai for $104? Hire an airplane. The metal is moved by you. Products are sent to you directly from the COMEX and LBMA warehouses. Once it's melted down to a consistency acceptable to China, it can be shipped overseas. And this is where the key distinction lies. The metal is gone as soon as it touches down in Shanghai. The Western banking system was using the silver as early as the 1980s and as late as 2011. Silver that had been financialized. Industrial stocks and critical sovereign reserves are now absorbing the silver that was heading east. More than 80% of the world's supply chain for solar panels is controlled by China. Silver is the industry's lifeblood, and they know it. Their goal in purchasing silver is not to profit from price speculation. For the sake of their energy future, they have decided to purchase silver. According to their calculations, silver is even more important than oil as a strategic metal. A geopolitical impasse results from this. Suppressing prices is an effort by Western banking systems to hide inflation and keep the dollar's credibility intact. They portray stability through the usage of paper derivatives. However, the bloc in Eastern Europe is taking advantage of the lowered pricing to stock up on real goods at a discount. Let the West keep prices down. They're content to do so. As a result, they are able to trade in their depreciating trade surplus dollars for valuable physical goods at a discount. However, the London vaults are now at an all-time low. The silver float, or the quantity that can be traded readily, is decreasing. The effects of turning money into a weapon are becoming apparent. Following the sanctions on Russia, all non-G7 central banks came to the realization that their reserves denominated in dollars or euros are not secure. Holding it is the same as owning it. This sped up the process of turning into precious metals. That being said, the Hunt brothers should not be considered when the price spikes to $91. Take the BRICS alliance as an example. Consider a methodical break with the Western paper system. They utilize leverage, the Hunt brothers. Cash is now being used by the purchasers. Margin calls on speculators are possible. It is not possible to make a margin call on a country that has already received the metal. The margin rules are open to revision by the New York authorities. Trading can be halted. They can attempt to prohibit purchases all they want, but the Shanghai Gold Exchange is outside their purview. They have no power to make India or China sell their stacks. Forever will unipolar pricing remain in effect. For half a century, London and New York were the centers of silver price determination. A new age has begun. At present, physical metal is migrating east, and the price power is following suit. The Western investor is thus put in a rather precarious position. To own paper contracts associated with the London fix is to own a stake in a vault that is about to be exhausted. At the end of the show, the silver will be in the east and the unfinished contracts will be in the west. It is time to examine the physics without the monetary theory. You can't run from the laws of chemistry, regardless of how much you disregard inflation and the dollar's impending demise. Silver is more than a pretty stone that some people keep in vaults. It stands out on the periodic table as the element with the highest conductivity. Its reflectivity towards visible light is unparalleled, effective against bacterial infections. Silver is a need in today's society. You must do it. Silver is essential for the green energy transition to take place. Silver is essential for the electric vehicle revolution. The growth in AI would not be possible without silver. Politicians unwittingly place a huge purchase order for actual silver every time they bring up the idea of reaching net zero by 2030. The solar industry is worth examining. This industry is rapidly becoming the largest consumer of the world's mining supply each year, and it's also driving technological advancements. New solar panels, such as those with high-efficiency TOPCon and HJT cells, utilize 50 to 150% more silver per panel than their predecessors. In the world of economics, this is known as inelastic demand. The price of silver is irrelevant to those who produce Tomahawk missiles or high-end AI servers. Depending on your product, the silver may cost $20 or $200. Silver is a pittance when put next to the price of a $50,000 server or a $1,000 missile. Do they cease purchasing if the price reaches $104? No. They splurge more. Concerned that next month there will be no metal to buy, they stock up. The scarcity is sidestepped by them. A retail wall is coming into contact with this industrial vacuum. If the market were functioning normally, we wouldn't be witnessing this phenomena. Rationing is taking place in the retail sector. Consider Costco. A big box store like this one is perfect for moving plenty of paper towels and rotisserie chickens. All of a sudden, they're among the most prominent American precious metals dealers. However, examine their website thoroughly. The out-of-stock banner appears often. There are hard limits on how much you can buy, 5 per member and 2 per household. To what aim would a store put a cap on your purchases? All they want to do is steal from you. They put restrictions on it since they are unable to replenish it quickly enough. The Costco signal looks like this. There will be a psychological breach when the typical consumer begins to purchase gold and silver bars in addition to their food, notwithstanding their lack of knowledge of futures markets and backwardation. The dealers are having a hard time keeping up with the early phases of a flight to safety. Pay close attention to the small print if you attempt to place an order with one of the main bullion dealers at this time. Words like pre-order will appear. Shipping will be delayed by 15 days. There will be mints waiting for restocking. They have not even acquired the metal they are selling you yet. Unobtainium is the name of the market situation that we are rapidly approaching. At this point, you can't really trade money for metal, so the price you see on the screen doesn't matter. It starts a never-ending loop. The premiums increase in proportion to the length of the delays. The discrepancy between the spot price and the physical price, which is currently $13, is only the start. Picture this. The premium goes up to $30 and then $50, while the spot price remains artificially high at $91. The spot pricing will eventually be shown in museums as an artifact of an obsolete system that no one uses anymore. It is well known in the industry. This is known to the strategic stockpiles. And just now, shoppers are starting to notice. There is a deficit in our budget. Over the past 4 years, global demand for silver has outpaced supply as measured by miners' output. Underground storage is being depleted to naught. Money can be printed. Legal documents can be printed. The element Ag, which has the atomic number 47, cannot be printed. They will freak out when the industrial users find that the vaults are really empty. Additionally, Raytheon, Apple, and Samsung will not be making a profit off of the sale of their silver, unlike a paper speculator. For the sake of maintaining production lines, they will store it in reserve. This is the point at which the physical bidding war takes over from the futures exchange in terms of price discovery. So, what does the decision say? A fork in the road has now appeared before us. There can't be an indefinite gap between the $91 paper price and the $104 physical price. Ultimately, mathematics always comes out on top. Be not naive, though. There will be resistance from the system. This data suggests 3 potential outcomes for which you should be ready. In case A, the paper gets smashed, we have cornered the bullion banks. They have exhausted all other options and will now simply flood the market with paper contracts. Their goal might be to drive the spot price as low as $80 in a single overnight session. Initiating your stop losses is their objective. In order to cover their asses, they are trying to intimidate you into leaving your position. Stop freaking yourself if you see prices plummeting but premiums remaining high. Yep, that's the catch. The uncoupling occurs in scenario B. The spot price loses all significance at this point. The $91 official pricing may not change. Still, $120 and $150 are the actual prices, the ones at which metal is actually acquired. The paper market will effectively shut down under these conditions. If you own an exchange-traded fund, ETF, or a futures contract, you may be compelled to accept cash at the lower price instead of the actual metal if it becomes unattainable. The market freeze is scenario C. There is no more perilous situation than this. The exchanges can easily declare a force majeure if the deliverable inventory reaches zero. Trading will come to a stop. Withdrawals will be temporarily halted. All you have are paper claims, and you won't be able to turn them into anything substantial. Now what's the plan? Put an end to using the spot price to gauge value. View it as something to divert your attention from. You should only care about the value of the metal that you actually own. Paper silver holders should be aware that they are effectively creditors to a defunct system. A counterparty risk exists for you. There is zero counterparty risk when you own real silver. You function as the financial institution. This level of volatility is too high to trade. Do not make an effort to use leverage cleverly. The robots will find you. We are not aiming for a quick buck at this time. Making it through the shift from paper assets to physical ones as wealth moves eastward is the main objective. Based on our conversation today, I have prepared a detailed technical report detailing the particular dealer premiums and supply chain constraints. Included in it is information regarding the arbitrage flows in Shanghai that the mainstream media has chosen to overlook. You can access the whole dossier by clicking the link in the description. Before you take any further action, read it. Disbelieve what I say. Have faith in the solidity of the metal you're holding. Take care.